We had a great accounting contest on Saturday. It was wonderful to see everybody, but you may have walked out of there feeling a little shell-shocked because the problem was a little complicated. I put together what I hope will be about a 9-minute video with my suggested solutions, so help you wrap your brain about exactly what happened. First of all, thanks to everybody for coming out on a Saturday to play with the debits and credits. I had a great time. I hope you did too. Here's a summary of the facts. We're going to sell a new product, hydrogen-powered vehicles. In the past, there's been some explosions, but we've got the technology safe now. We have governmental approvals. The sale price is $75,000 a vehicle. The cost to us is $55,000 a vehicle. We're going to buy back these things for any reason in the first 2 years at a sliding price, starting at 93% of the sales price and declining to 45%. We're also going to sell fuel cells at a loss of $84 per fuel cell for the first 2 years. Fuel cells will last about 4,500 miles, and we think that the weighted average miles per car driven will be 12,000 miles for the first 2 years. The issues I saw, and I think that everybody saw, were we have an issue of variable consideration. We're not really sure how much we're going to get paid. We're going to sell these things, but are they going to stay sold? And that raises an issue of constrained consideration. Maybe we shouldn't be booking anything at all if we don't think we're going to get paid. There's an issue of expense recognition around the fuel cells. There's a disclosure issue that everybody saw. So in the MD&A, we've got to talk about if one of these things explodes, that's going to hinder our liquidity because we're going to have to buy a bunch of them back. It's going to make us hard to raise money long term. That's going to hurt our capital resources, and it's really going to hurt our operations. If we book any revenue at all on the sale, we're going to have footnotes that talk about the fact that our financials are full of estimates. And we're also going to have to talk about a tax-deferred asset created by any deferred sales or tax-deferred assets created by those fuel cells that we're going to be selling next year but recording the expense for this year. Remember, there's 5 steps now in the revenue recognition process. Identify the contract, identify the performance obligations, price the contract, price the performance obligations, and recognize revenue as the performance obligations are satisfied. And if you look at step 3 in our textbook, it talks about variable consideration, or the price is dependent on future events. Might include discounts, rebates, refunds, things like that. And the way that we're supposed to estimate that, there's only 2 ways now: the expected value, weighted average, or the most likely amount. And here's the code section that says we're supposed to use weighted average or most likely amount. And I'm just not sure there's any way for us to do either of those methods in this fact situation. I made up this example to talk about variable consideration and constrained consideration. Suppose we're a contractor. Holy Names comes to us and says, we want you to build us a shed to house our new backup supply for IT. We want it done over the summer. If you get it done within 3 months, before 3 months, we'll give you a bonus. Well, the weather's very predictable in Oakland in the summer. We've built thousands of these things. We expect we'll get paid the bonus. We're supposed to include that bonus when we record the revenue from this transaction. We can't bill it to the customer, so we'll have a contract asset to balance that out, so the account receivable may be less than the revenue we record. Contrast that, however, with we're building our first bridge ever in Soldotna, Alaska. It's supposed to take 3 years, and if we get done in 3 years, they'll pay us a bonus. Well, I don't think we can make that we can expect that bonus. It's our first bridge. We don't have any experience. The weather could throw us off. I think that's constrained. That bonus is, in the jargon of the new revenue recognition rules, constrained consideration. We can't count on it. So what factors are we supposed to look at? We're supposed to look at the amount of consideration. Is it highly susceptible to factors outside our control? A couple people post fake YouTube videos of our cars blowing up, and we're dead in the water. Is there uncertainty about the considerations that's not to be expected to be resolved for a long period of time? We won't know for 2 years. Do we have any experience with similar types of contracts? No. D says, does the entity have a practice of offering a broad range of price concessions? Not really, but E is right on the money. The contract has a large number and a broad range of possible consideration amounts. 0 cars could stay sold, or 50,000 cars could stay sold. We could book $0 worth of gross profit, or we could book $1 billion worth of gross profit. That sounds like a broad range of possible consideration amounts to me. And I just don't think we have the experience to do that at this point. I had hoped that when you saw this problem, you would remember a problem we did in class when we were talking about revenue recognition. We open up a new shoe store. People can return shoes for any reason for the first 7 days. First day we have sales of $1,000 that cost us $600. And I think we all were pretty comfortable with saying we got to wait a week to book that revenue. One way to do that: debit cash, credit sales, debit cost of goods sold, credit inventory. Then debit the contra revenue account, sales, returns, and allowances, credit allowances for sales and returns allowances or accounts payable. If we're not going to book the sale, we can't book the cost of goods sold. So debit estimated inventory return account and credit cost of goods sold to take the cost of goods sold off our books. You would have also seen this pattern if you looked in chapter 18 of our book, where a company sells cameras. They get to the end of the month, they think one more is going to come back, so they debit sales, returns, and allowances for 100. They credit allowance for sales, returns, and allowances for 100. That's the sales price. They debit the estimated inventory returns for 60. That's the cost. And credit cost of goods sold for 60. Here's the actual code section that says to account for a transfer of products with a right of return and for some services that are provided subject to a refund, an entity should recognize all the following: revenue for transferred products and the amount of consideration to which the entity expects to be entitled. Therefore, revenue should not be recognized for products expected to be returned. C says we got to book an asset to undo the cost of goods sold. And B talks about a refund liability. I think that applies here, even though I'm pretty sure those words were intended for the service situation. Assuming we can convince ourselves and our auditors that we can make a prediction about how many of these cars will stay sold, this is what the journal entries look like. Here I presumed 5% come back, spread out evenly over the 2 years. We book the sale, we book the cost of goods sold. That's $1 billion worth of gross profit right there. We book some sales returns and allowances for 5%. We book the estimated inventory returns, so we take the cost of goods sold off our books for 5%. And then I put this repurchase liability on there too, even though I'm not sure that that's the right thing to do. These timing differences create $54 million worth of a tax-deferred asset. Thanks to Naz for pointing that out to us. And in general, I'm just not real comfortable with these journal entries. We just booked $1 billion worth of gross profit, and all these cars could come back to us in 60 days. I looked again at chapter 18 of our book, which is called, and in there there's a section called the Repurchase Agreements. And there's this great footnote that says if the repurchase price is less than the selling price, then the transaction should be accounted for as a lease. If you would listen carefully to the first 30 words or so. If an entity has an obligation to repurchase the asset at the customer's request, a put option, at a price that is lower than the original selling price of the asset, the entity should consider it at contract inception whether the customer has a significant economic incentive to exercise that right. If so, we should account for it as a lease. Does the customer have a significant economic incentive? And I think the answer is we don't know yet. But accounting for it as a lease seems like the most conservative way to account for it until we do know if that's a significant incentive for them to sell the thing back to us. And please note the FASB didn't say put option reasonably certain to be exercised. They know that language. That's in topic 842. They didn't say more likely than not to be exercised. They know that language. It's in topic 350. They simply use the word significant. So I quickly grabbed my calculator and went off in completely the wrong direction. Said it was a sales type lease. Assumed even sales over the next 24 months, even payments of rent. Figured out how much of that would be interest and how much that would be principal if we're looking at a 3% implicit rate. Then I booked the transaction like a good student, debit, lease receivable, credit sales. And then we're going to book some of our revenue over time in the form of interest revenue. And that's all good and great, but it's just wrong because this is a cancelable lease, not a non-cancelable lease. And so we're also still looking at booking some gross profit, and I wasn't real comfortable with that either. So remember, there's the 5 tests now under topic 842, but overriding them is the notion is it a cancelable lease? And this is a cancelable lease. Hence, I don't think this is a finance lease from the lessee's point of view. I don't think it's a sales type lease from the lessor's point of view. I think it's an operating lease. The more I thought about the conceptual framework, I was thinking this is not doing a service to potential investors. This is not booking gross profit is not a neutral approach to this, and it violates our revenue recognition rules. So I kind of fell in love with the operating lease. Debit cash, credit unearned lease revenue. As time goes by, we recognize some lease revenue. We'll put on our books an accrual so that people know that we're going to have to spend some money to buy these things back. And we'll just appreciate these things because it's an operating lease. It looks like we still own these vehicles. Kind of the clincher for me was after 2 years, we will know if they have a significant incentive to sell these things back to us. And then we can make a good estimate of what future returns are going to look like. And we can institute a change in accounting principle, which everyone remembers means we go back to the beginning of time and restate our books as if that new principle had been in effect from the beginning. So management will get to book their gross profit when we go back and make a change in accounting principle. Then there's the issue of the fuel cells. Just like warranty expense, that loss we're going to take next year should be part of this year's net income. And hence we're going to have a timing difference where I have a tax deferred asset for 30% of that loss on those future sales. In summary, we made this problem too complicated. One way to fix it would have been to give you guys a coach, maybe give you the problem in advance, but you did an outstanding job with the 3 hours you had. Thanks so much for coming, and great job.